We welcome you to the June meeting of the Central Illinois Marketing Club. And tonight we're going to talk about profitability because I think everybody has certainly noticed declines in market prices for corn and soybeans. And we know that costs are not declining. We also know that somewhere this summer we're probably going to be starting negotiations with landowners for cash rents for 2024. And so that's what we were thinking about, what the steering committee was thinking about when we put the program together. We're very honored tonight to have a couple of field staff from Farm Business Farm Management, Craig Macklin, who is in the Decatur office, and Matt Harriet, who's in the Tuscola office. Next to Matt is Tom Corson, farm manager for Field Level Ag at Mount Zion. And next to him is Steve Myers, head of Busey Farm Management, and Steve's up at Leroy. And so between Matt and Steve, quite a few miles got accumulated this evening here. But we appreciate them being here. This is going to be somewhat of an open conversation between them and you. We'll start out with kind of their perspectives from Craig and Matt on what prospects for profitability look like coming out of 23 and going into 24. So see what we got in the bank account and what we've got as a base in there for any cash rent negotiation. So let me start with Craig and Matt, and whatever comments you'd like to make and whatever questions the group has, why I think will benefit everyone.
Well, I guess I'd start saying that we're in a pretty good cash position, I think. At least the people that I deal with probably came into this year maybe in the best shape ever, coming out of probably the best couple years of farming, at least since maybe 73 and maybe even before that. So I don't, hopefully if this thing doesn't last too long and we get back to some good prices, maybe we won't see too much financial distress. But it's obviously concerning because we got pressures both on the prices for your commodities coming down, and your input costs have really accelerated. I think probably the biggest percentage increase I saw, and I don't know, and everybody talks about fertilizer, I think, but probably from the percentage increase, fuel was the big thing that really hit everybody, I think. I think that we're just, I don't know, I don't know what else to say about that, I guess. We have an opportunity, I think, here in the short term, maybe, as this drought conditions, to maybe take some advantage of some price uptick. Don't really have a crystal ball on what's going to happen with prices. I guess my thought is that the input prices are going to remain kind of static. I think with the downward tick in commodity prices, I can't see that they're going to continue to increase, but I think there's going to be a lot of resistance for coming down very quickly, much lower. I think we saw that in 2012. We took a couple years for those input prices to come down, and I would assume that we're in that same sort of scenario. Hopefully we're not in that same sort of scenario. I think that was a bad blip of years, but I think if we are and we stay in that lower income level, then I think it's going to take a while for the pressure on those input prices to come down. But I don't see that they're going to continue to increase. I mean, we've already seen them come down quite a bit, right? So, so going back to my first point, I guess, is that we're in a pretty good cash position. So I think even as we go through this year, and things stay the way they are or even deteriorate a little bit from your standpoint, as in commodity prices coming down and input prices staying where they're at, I think we're still going to have an income tax problem this year because you guys carried in a lot of grain, or I think most of you carried in a lot of grain. And I don't think you're going to see, from a cash standpoint, that you're squeezed too tightly because you're in such a good position coming into the year. But then we got the interest rate thing, and that kind of concerns me. I mean, I was a kid in the 70s, or early 80s, but I remember how that really hit us. And if the feds can't get this interest rate under control, I don't have a crystal ball. I'm really not sure what's going to happen. But I mean, that's definitely concerning, because it's, as your gross income comes down, your input costs stay stagnant at a high level, you're going to need more borrowing, and it's going to be at a higher interest rate. So I think one of the things that was interesting, that Matt and I were at a conference here about a month ago,
Yep.
and one of the things that was pointed out, and maybe it was actually before the conference, but it doesn't take much of a decrease in your gross revenue and an increase in interest rates. If you're one of those people, like probably your banker, that's looking at ratios, it doesn't take very long to take a very good ratio and turn it into a bad ratio, because if you're looking like at your interest as a percent of gross, interest rates were low, gross was high. Now interest, you're probably borrowing a little bit more money. It's a little bit higher interest rate, and your gross is now decreased. So that interest as a percent of gross figure that some banks are looking at is going to really change drastically, as will the operating expense ratio. And so, you know, your net, the residual of that is your income as a percent of gross is going to basically go down drastically because those other categories go up. So just from a ratio standpoint, or looking at financials and working capital and things, those things can change in a hurry. And you guys are dealing with a lot of dollars, obviously. You know, I don't know. I'll let Matt.
I agree with a lot of what Craig says. I mean, like he touched on the input prices. I feel that the seed and chemical is going to probably remain the most flat going forward, but the fertilizer and nitrogen, those are kind of the two biggest costs for producers. And we have, I don't know if anybody's talked to their suppliers, but that, especially the nitrogen cost, has come down a lot from where people were paying in the fall. And then as Craig kind of talked about the interest rates, I mean, if you take someone that was paying 4% last year interest, 8% now, and that interest expense was $20,000, well, now you're at $40,000, so that money's got to come from somewhere to help pay that banker. And I think we're kind of blessed to be where we are as far as the ground that we all raise crops on. I'm sure some people are on some tougher soils, but if you think about $6 corn at 200 bushel, you're at $1,200 gross revenue. But if you're able to produce at 240 and we're at $5, you're essentially at the same gross revenue. So I think we're blessed in this area that we can kind of outproduce the cost, or the lower production cost. So I had one other point I was going to make too. As far as the interest rates, and you're looking at buying your inputs for the next year, I think we really need to look at our input prices. If we got to borrow that money and we got to pay 7 or 8% interest, is it better to lock that price in now in July or August, whenever the past couple of years that seems like when fertilizer people have been after you to lock it in, or do we need to wait, keep our cash or keep our operating loan down, and then wait and buy it closer when it's actually put on, or carry it into January or later? So I think that's some important stuff to look at as we're trying to manage some of this cash with increased cost and potentially lower revenues coming forward.
Are there any things that farmers may not take a look at real closely that could come up and be unintended consequences or something that's totally unexpected? Have you advised any of your clientele about, hey, you really kind of need to watch this, other than those major things of fertilizer and interest cost?
I think the biggest one is always family living. I think a lot of people do not have any idea what their family living is until you actually get to the end of the year. 2020 was one of the lower, I'd say, in the last 5 years of family living costs, but that was a lot due to COVID not going anywhere. And then 2022, we were at the highest that we'd ever been for the FBFM clientele. So I think it's important to look at that family living and know exactly where all those extra dollars are going.
I would second that. I mean, we definitely have ramped up our living expenses, and it's easy to do, right? If you got the cash, it's easy to go buy the boat or the camper or whatever. I don't know how easy that is to ratchet back. Probably not near as easy as it is to increase it. I think the other thing, I mean, the big item is equipment purchases, and I don't know. I mean, you want to have a good equipment line, but people have spent an inordinate amount of money on equipment, and I know part of that's because of us trying to get taxes down, but you're only saving 35 cents or whatever on the dollar. You still got to come up with the other 70 cents or 60 cents or whatever the case might be. And I know that part of that's out of your control, because if you need something now, it's going to be high, right? So, but I think we need to really think about family living and capital purchases before we extend ourselves, at least, unless you got the cash sitting there.
Do any of your clients ask about rent issues, about what you think, or what maybe U of I Ag Econ or FBFM folks think about cash rents, what for the coming year, whether they're paying too much this year, not whether they're paying a reasonable amount, if it's fair. Have you gotten into any discussions with any of your clientele on cash rents?
Yeah, it comes up. I mean, nobody has a crystal ball, right? And so I think, and maybe you should shut the video off here, but I think actually a lot of people that are paying cash rent in the last couple of years have actually probably came out better than the people that are 50-50. But I think that is very unusual. I think it just flip-flopped because we had such a run-up in gross revenue, and the cost didn't catch up quite as quickly. I can see, though, actually I ran some numbers today. I can see that the ability to pay that cash rent, if what I think might happen this year, from an accrual basis at least, happens, then our ability to pay cash rent might be slashed almost in half, if you want to look at the real numbers, back into the high 200s, maybe. From, I mean, I think I know there's people paying on at least tracks around 5 or high 4s. And I think it penciled, in the last 2 years. I actually think it penciled, at least in some scenarios. If you had the right ground, everything was right for you, I think it penciled out, but I don't think that's the case going forward. So I know some people have got themselves in that situation where they're probably sort of locked into that for a year or two, unless they want to renegotiate, which is probably always a hard thing to do, is to go to your landlord and renegotiate, but it might be something that needs to happen.
Okay. Any questions from the crowd? You folks are welcome to ask at any time if you want any details from these guys.
How has depreciation costs changed over the last couple of years?
So depreciation has increased quite a bit, the depreciation cost. I think I've got several clients that are, we're buying and we're expensing everything off. And then obviously just because the equipment costs have gone up, depreciation costs have naturally gone up as well. The other thing that kind of comes into play too was the new tax, well, it's not really new anymore, but the Tax Cut and Jobs Act tax code, whenever we had to change the way those trades worked, where you weren't just looking at the net, you had to, pay the tax on the gross and then pay the tax on the trade-in and then you could expense the full new cost. So depreciation costs have gone up. And a lot of that, I think, has to do with the last 2 years of very, very good farm revenues. And again, I think going forward, that might be something to, kind of start bringing back in check a little bit, to save some of the cash and working capital.
Yeah, I agree.
We had a discussion a few meetings ago about flexible cash rents. Do you have any analysis how those work on a year like this past year? Did they work out for everybody, or did they not? Or?
Well, unfortunately, I think there's several variations of that flex rent out there, obviously. And the most easy one, and the one I think that got put into place the most often, was one that didn't give a lot of downside protection to the producer, but more of an upside to the landowner. And I guess maybe that's, obviously if you're a landowner, that's not all bad, but it made a few of my producers very upset, the way and what they ended up paying, which if you figured in all the bonuses and everything was extremely high, probably even higher than the number I.
500 to 600,
Yeah.
right?
Right.
Easily, yeah.
Yeah.
And that probably.
On the 2022 crop.
Right, and that probably is a little bit more than the 50/50 equivalent, I think, at that point. But, some of those 50/50 leases also have some sort of privilege or bonus rent, and so, I mean, it's better than not having it. It's hard to have a blanket statement because there's so many variations in the way they're dealt. But I really like the ones that tie, like production costs and, well, I say I like it. I like it in theory, but managing the thing is a monster, right? Trying to figure out what your dates are and what you're using.
Well, some of you all had examples of that, and I just wondered if it would be good to see an analysis, what worked, what didn't. I would think you would need something, like you say, that if it was just on gross, they would go up, heck, maybe 600 or even better on some places, right? But the ones that I think you talked about that build in some production costs to that, where there's fuel prices for something there that without getting too complex, it'd be good to see, okay, how did that work, right?
As far as I know, I do not have anybody that actually triggered one that had production costs as part of it, unfortunately.
So I would say that it worked out pretty well. I mean, I had a lot of guys that came in and brought in, their supplement or bonus rents, that were extremely happy, high yield environments, great prices, of course, at that time. So I got clients that are happy, tenants that are happy, everybody's gung-ho, getting ready to go forward. As far as managing the production cost part of the lease, I think you just make it as simple as you can. You rough guess it. Maybe it's not actually your production cost, but, maybe look at like the University of Illinois or Iowa State. Wisconsin's got some good numbers out there. I think you got to look at those, simplify that. There's no reason to make these leases, 10 pages long. Make it so you can put the flex part of the lease on a page, simplify for everybody, and then just move forward. But I think those, like I said, I didn't have anybody complain about coming in and bringing what was the highest bonus rent payments that they'd ever come in. And some of mine, a lot of mine still had a max amount of rent. So they were well above that. If you calculated the actual rent calculation without going to the max,
A cap.
I'm sorry, maximum total rent, on there. And some of those rents would have been almost $100 higher, like $650 in that 250, 270 bushel yield range. It was pretty astounding at what it would have been, but they were capped out, and so maybe that's why they were happy, because they felt like they, it saved a little bit of money because of the cap, or, and some of the other ones with the production expense. I know Busey runs, several of those with production expense deductions off the gross as well, and it's more of a bonus on the net. And maybe that's what we all need to look more at going forward as a safety net for you guys, as well as the owner and the operator. It gives everybody a little bit of a safety net, knowing what those expenses or kind of building those in to the equation.
So we sat here a year ago, and to address your question a little bit more, sat here a year ago in June of 2022, right before we were starting to tap that $7.50 price, third week of June or whenever that was. And what we talked about is some of those tumblers. I talked about 35-42 last year, 35% of the corn, 42% of the beans. Those tumblers are all over the place. There's 38-44s. There's, every type of, combination available. But as a blanket statement, here's what I did with my clients. In light of higher input costs, I did two things. I lowered my tumblers from like a 35% on corn gross, 42 on beans, downward in light of rising input costs. But I also raised my bases to stay the pace of what the marketplace was. And those bases went up 5 to 10%. So bear with me. If it was a $300 base, I raised it to $330, $340, $350, but lowered that flex portion to like a $33, $39, arbitrary numbers, mind you, but lowered it to help address particularly those higher input costs that go in there. And to a person, the folks that I worked with in that regard were very happy to sign that. They recognized that the marketplace, because we all had cash in our pocket, the rising tide raised everybody's ship to say 400. Again, another arbitrary number, but in light of the higher input cost, I dialed down to try to address that. Now, will that work in 2023 in this growing crop? We'll soon find out, because when you do the math today at a $400 cash rent, 230 bushel corn, 5 and a quarter, 75 bushel beans at $12, $400 is going to put you about break even after your costs. And I'm talking about like $150 an acre machinery costs, and your kind of standard off the rack for your input costs, meaning 90 cents to $1 a pound for your nitrogen, 900 to 950 on your P&K side of things, a $300 bag of seed corn, et cetera, et cetera. My point is that, as Tom mentioned, as we go through, or Craig really said this too, is when we quit living in that happy-go-lucky Matthew Harriet gross world, and we lop that $200 off, where are we going to go? And again, at $400 an acre today, cash rent, $400 an acre, do the math. At 230 and 75 bushel beans, that's your break even. So if you paid 5, that math's not going to look very good. And so tomorrow, what tomorrow brings, I have no idea. But I think that the FBFM fellows are both spot on. Maybe our salad days are over with in terms of those big whopper rents. But we had a lot of producers who were driving those same rents up, right? And you heard of some cash rent auctions. I never attended a cash rent auction ever, but you hear about crazy like $525 cash rent bid for a farm. Well, I think the things with your landowners that you gotta address is, what were the provisions of that lease? Can I bid 525 with no fertility clause? Huge ticket item, right? So what are you comparing apples to apples? So I talk a lot, I'll shut up, but $400 rent, 230 bushel corn, 75 bushel beans, today, at today's prices, is your break even. So you better have that 230, 240, 250, or you better have 75 to 80, or else you're in danger of going below that Mendoza line, so. I think they have to come down. If all things stay as they are right now, I believe 2024, you tell me, guys, they've got to come down.
Yeah, no, I think you're on the right track there too. And like Steve said, we lowered that little percentage on the flex. U of I had at one time 42, 38 or something like that. We've brought that number down, as expenses have gone up over the last 2 years. And I think that's helped a little bit get a little more fair than it was. It used to be $400 to put a corn crop in and $200 to put a bean crop in, and everybody's happy. And now it's, $750 or whatever. So yeah, I think those little things have come down. The bonuses were still growing. As we were doing that, landowners' expectations are going to be as high as it was last year or, higher. So, those conversations that we're having with landowners right now, and I'm sure you're doing the same thing, is we're preparing them for, some changes. I mean, we had a lot of gravy the last few years, and it might get a little leaner on just the cash that's available for, for the landowner, for the guy that wants to bid out another farm. We might see those numbers come down, but, like I said, there's a lot of operators out there that have done very well, and they're still, I would assume they would still bid some pretty hefty rents in today's world. Like, I haven't been to a cash rent auction. I've seen some like in Iowa. I don't know really if any of them around here. I've seen some, where farm managers have put it online, requested bids, but, and I've heard some results of those being pretty high.
Yeah, there was one in northern McLean County this spring at 525.
Yeah.
For just like B+ ground. There was nothing fancy. But I suppose, I don't know, I suppose someone looked at that and says, hey, it's just 120 acres. And, if I take a whipping on this, I can do that. But, playtime's over, right? I mean, it's, and like I said, before I pat myself on the back for lowering those tumblers, what did I say? I raised my bases, right? So,
Yeah,
I mean, it wasn't, but I thought that, I felt, and I think our producers did too, felt that was a good trade-off I might have got $30 more on the front side, but gave up 30 to 50 on the back side. Right. That's how that math worked. But it was a recognition of those higher input costs on the flex side of things, so. Probably in that same math as and I'll ask Craig and Matthew, but in the same math that I did at that $400 rent today, your 50/50s are gonna net you about $150 versus a zero on a $400 cash rent today. That's what my math says. So said differently, if you're on a crop share standard 50/50 lease at those same numbers I've been talking about, it's $150 net to the farmer versus a break even on the $400 cash rent. And I think, again, that's the halving, right,
Yep.
that Matthew was talking about there too. So pretty stark. I mean, it gets pretty serious in a hurry.
Yeah, because it all gets back to family living and income taxes. It's got to come out of that. Whatever you make on those acres, you got to pay those somewhere, off some acre somewhere, or borrow it,
Right.
and hope to pay it next year. So.
So as older people, I'm making fun of Matthew for a second. I used to work with his brother, but are we ready, right? That's the question that I would ask this group, right? Are we ready for that? Are our spouses ready? Are our families ready to not be able to maybe do everything that we wanted to do, right? And it's been great. It's been awesome, but and I'm not saying that this is the 1980s, a far cry from it. Right, but what was before the 1980s? Well, the late 70s. Late 70s, pretty happy, right? And then all of a sudden, all heck breaks loose. So, and again, I'm not predicting that, but I think that we have to mentally prepare ourselves, not just from a cash rent standpoint, but just trying to live maybe we didn't have to worry about our budgets as much as I think as we do going forward, so.
Well, I can understand your issue with the landowners too. I mean, you just paid $20,000 for a piece of property, and then you say, well, you might not be able to get as much rent out of that as you did last couple of years. That's a hard sell too, right?
Yeah.
And get you 1% return on that.
Yeah. And that'll, I'll ask Tom Corson, so what will happen then, Tom, to farmland values?
Yeah, so it's gotta, at some point, it's gotta affect farmland values, and I don't think we saw any of that this spring. We had farm sales drag into later spring than we've seen them in the past. I know we got some sales coming up in July. I've never had a July auction before, but the landowners are kind of seeing the writing on the wall, and they say, oh, we want to have this thing in July, because we don't trust what might happen in the fall here. So let's get this thing out in front of everybody else's, and as soon as we can. So yeah, we'll be coming with a good farm on July 20th, and we'll see what happens. But at some point, you're not going to take a 1% return on your investment when I can go to BC Bank and get 5 on a CD.
Right.
So that's going to be your competition. Is the bank's interest rate has really not been a competition for your cash for a long time, and now it's looking a little more favorable. Stock markets, maybe a little too volatile for some people's stomach, but a good old-fashioned CD, pretty nice right now compared to what I could get you on the last farm we sold was $23,700, and I don't think I could get you 5% return on that one. So
Think about 300-400 basis points on that borrowing cost on it, just a $10,000 piece of dirt. Where am I going to get that extra $300 of revenue? Just at a $10,000 piece of dirt, let alone a $20,000 piece of dirt. And that's the difference between a 4% rate and a 7% rate, that 300 basis points. Holy cats, something's going to have to change. Or else, and what would stave it off right now is, Iowa took it for us last year, right? Maybe we're the Iowa, right? Where we might be drier. I'm not predicting. I love your crop down here right now. But Iowa took one for us last year so we could produce that 240, 250 bushel corn at, a 630, 640, 650 average price. And they had less bushels where we had we had the robust bushels. So, it might be our turn. I hope not. I don't think so. I think we've got a nice crop growing. We do need rain, but again, income gets pretty pedestrian in a hurry. So I can't see any, I'm not saying that farmland prices are dropping, and Tom's not either.
Yeah.
But if you had a bias, it would certainly have to be neutral to lower rather than neutral to higher, right? Because I don't know, but by bias would be.
yeah, and you also got to get rid of all that cash that's out there before any of that really comes into play. So if a guy's sitting on more cash than he ever has and wants to get rid of it, and is not going to put it in iron, in machinery or drainage tile on his own farms, and a farm comes up and he wants to buy it and he's got cash, that interest rate is a non-factor to, I would say most farmers that are actively buying. So we could still go through what I'd call the next selling season, which would be from the end of crop harvest to planting, and not see much of a downturn on land values. The inventory might slow down, but like I said, there's still buyers out there, and a lot of the buyers, up into the spring, we're still doing a lot of cash purchases and no financing.
Let me ask Tom and Steve as you talk to your clients, are any of them expecting cash rents to go up like they have been in the last few years? Are they expecting them to go up this next year? Are they wanting more cash for 2024?
Yeah, I really don't think so, quite honestly. And so when we went to our clients and said, hey, can we turn those tumblers down from those higher levels? I mean, again, don't pat myself on the back. I did raise the base, right? But I think that it's been so widely publicized too, those nitrogen prices and those P and K prices and that we're catching up to us. So, you're always going to have that core or small group of people that's always gonna try to push that envelope. And just as there's producers who are always gonna push that envelope on paying high cash rents. But, you know, I think that, I think when we looked at those flexes, some of the numbers that we were throwing around earlier, I think that we had a lot of landowners that were just shaking their head, just couldn't believe how much money, you know, that we printed out there, and were just tickled to death. And were willing at that time to turn these things down a little bit in face of these rising costs. Now, nobody likes to take a pay cut, right? So what will be the reality, you know, 4 months from now? But by and large, I think, I don't know, Tom, I think they're kind of ready for it almost.
Yeah, I think a lot of them are, but just like everybody else, so, you know, we're talking about that cost of living, you know, just like with a lot of operators, their cost of, or their family expenses have gone up. You know, these guys that, you know, got these big bonuses, has found money in December, January. You know, it doesn't take too long to become accustomed to, you know, large amounts of cash like that. So they've probably changed their lifestyle a little bit. So it's going to be a little bit of hit. Like you said, they're going to take a pay cut. They might not realize, you know, how soon it might happen or that, but, you know, there very well could not be, there might not be a bonus in the winter, and they'll have to get used to that, and then have the, you know, we'll have to have the conversation here this, you know, in the next few months about what cash rents will look like, you know, for them in the spring. So you take that bonus out. That bonus was a big factor. I mean, it was.
In some cases, almost double what your base was.
Yeah, so I mean, a lot of those with the bonus rents, I mean, their bases are, you know, just naturally lower anyway. So it's going to be a little bit of a shock, but I think they were just as equally shocked last year when they got those big checks. So
It'll be a hard one to swallow, though. I mean, for all of us, right? I mean, it's going to. I mean, again, I'm not. You know, here's the great thing for me. You know, when we got past crop insurance at $5.91 corn, right? What did we know? We pretty much knew we were going to make a profit this year on March 15th. Isn't that nice? And for us in the room, it always hasn't been that way, right? So you could enter the 2023 planting season saying to yourself, with our spring prices, that we might not carry out buckets full of cash, but we're going to make something, right? We're going to have a plus in front of it. And we're going to have a plus in front of this 2023, no matter what happens, you know, with crop insurance covering our bed. Again, as we go, unless we did something silly, right? You know, we went out and bought a bunch of iron, bought a bunch of high-priced dirt, and paid $500 rent on a base. So, you know, as long as we kind of kept our cookies together, I mean, I think we're gonna be okay. But again, managing those expectations in 2024 and 5 going forward, that's, again, I just say it like this with no offense to the ladies, is, you know, making sure mama's on board here, right? Because, you know, maybe we can't go to the Ozarks 4 times this summer, or whatever, you know, but we, to rein in our spending, and it's great to live well, and that's why we work hard so we can live well, but the adjustment period will be a little tougher to swallow, I think.
Other questions? This is open question time. Anyone else?
I'll talk real quickly, Tom, and Matthew, we were talking right before we came in. I do think that this area's got the nicest crops I've seen. And I've been pretty much in the northern 2/3 of Illinois. In the last 8 days, I've been everywhere. I've been to the Quad Cities, to Yorkville, to Hoopston, to here, and everywhere in between, Carthage, and everywhere in between. Really a solid crop out there. I call it a B+ crop. There are areas that are drier than you are, but by far, in terms of robust growth, especially in your corn, you know, is really a nice, I think you've got a wonderful crop, the nicest corn crop I've seen. Where is it bad? You know, it's probably not bad. Again, Tom and I, you know, you can pick up some pockets. Talk about maybe your Sankamon stuff, or where you said you got some big board.
Yeah, so I managed some farms down, you know, south of Springfield in that Chatham area. You know, 2 weekends in a row, excessive amounts of rain, totaling almost 10 inches with hail on top of it. So those areas looked a little rough. We had quite a bit of replant in those areas. That second weekend, it really scattered clear down to Morrisonville and got some of that area where he had some issues and some replant. But I got some pretty good ground that's dry. I would say Warrensburg, the east side of Mount Pulaski, is a little tougher than it would be. But I talked to two guys on the way down here, just kind of picked their brains on a couple of things I figured we might talk about. And of course, we ended up talking about the crop, and both of them said that they think their crop looks better today on June 6th than it did last year on June 6th. And I got to thinking about that, and I was like, that's probably true, because we didn't get off to a great start last year. We didn't have, like one fellow said, all the corners are filled in, everything's uniform, it looks great, other than, it's under some stress. And I think an inch of rain this weekend, and we'd probably forget about what it looked like, Monday morning, so.
Anybody else?
On the crop condition, the one thing that, and I agree, I think our crop looks good, I'm pleased with that, but when I was traveling around the state, I always used what people's lawns look like when you drove by as an indicator, kind of adjust what I was going to say to those folks, right? But our lawn is, I can't remember when it was as bad as it is now.
Yeah.
As far as all, lines going through. And I really can't figure how the crop looks like it does and the lawn looks like it does.
Yeah.
It's really changed.
Tiles are still running. The tiles are still running. So, once we run out of tile water, right, we got about 30 days. That's when the clock's ticking. And the only thing, I agree 100%. I look at the yards. And the only thing I could say is 92, 91, and low humidity, right? We've had that low humidity that's been churning on it. But, if you say knee-high by the 4th of June, right, how much corn we got knee-high? A lot down here, a lot. And I think that speaks to the crop. The beans have been really kind of bothering me all year. I just don't like, I think my beans are less vigorous, floppy. I can't explain where they're at right now, but looking at yards, again, everywhere I've traveled, that's absolutely a true statement. But again, we still have tiles that are still running. And then once that tile water stops, your soil profile in this good dirt, you got 30 days, your clock is ticking now. So you need one pretty soon, is what I'm saying. I want one, but I don't need it. I want one pretty soon.
Yeah.
So, yeah.
I don't know what the actual percentages are, but it seemed to me like this year's crop might be the earliest crop, at least in this area,
Yeah.
ever,
Yeah.
when it was totally planted, done, or almost totally planted.
How many people were done in April? Yeah, I mean, has that ever happened?
2012.
Besides 2012, yeah.
Now we're in March.
Yeah.
Yeah.
Good Friday was in
Yeah.
March in
Yeah.
2012. Yeah.
Yeah,
We were planting Good Friday.
so, yeah, I mean, it went in, and it went in in a good week. It was nice and warm that whole week and looked beautiful. I don't think there was a bad decision made that whole time. We might find out different in the fall, but I don't know how you could, why you'd want to change anything right now. I mean, it all looks pretty good. I had some March 30th beans planted, got zapped with some frost, replanted them, checked them across the way, and you can't really tell the difference between the ones that survived and the ones that were planted a month later. But I'm like you on the beans. I'm waiting for a little vigor. They need a little rain or something. But lazy is a good way to put it. They've been lazy all spring.
Let's give these guys a hand for their contributions tonight. We want to bring in Kent Stutzman. Kent is going to be with us virtually, so we'll catch him starting out in just a moment.
This is here to give you an update on the market since the last time when we met in early April. Apologize for not being able to be down there in person, but have some appointments here this afternoon and tonight that are going to keep me away. But with technology, we can still get you the information that I normally bring. So July corn, these prices on the close here are as of noon today because I had to record this early and I couldn't make it to the close because of some other appointments. But the last time we got together on I believe the 4th of April, July corn was $6.28, currently $6.10, down 18 cents. However, we had a range of 647 to 547. So you can see we've come off the low a decent amount, and we're trying to inch up towards the high, but July corn has really struggled as of late to get above 6 and stay there. Maybe the last couple of days here we've been, or at least today so far, we're okay. We'll go into some of the reasons why here in a minute, but that's what we've seen on old crop corn. Old crop beans, unfortunately, have been even worse. 1482 to 1362 at the present time. We've had a range at 1501 to 1270, so a $2.30 range from high to low. You can see at 1362 we're nowhere near the high, much closer to the low than the high, and things have really got to change from a demand standpoint or crop prospect to see old crop beans rally back to that level the way it feels right now. December corn for new crop, 560 to 544, down 16 cents. We had a range 565 to 491, so 74 cents. You can see we've bounced off of that low by over 50 cents, so that's been a nice recovery. We will see as we go forward here, again, if we can crack 550 and try to work back into the 560, 70 range. Weather will obviously play a big part in that. November beans, 1320 to 1191, down $1.29. The range, 1325 to 1130. So again, you can see we are closer to the low than we are the high. Obviously some big movement the last 2 months in soybeans, both old crop and new crop, with some big crops coming out of South America and really just an overall lack of demand. I don't have any slides in here for the 22 stuff because I've been preaching forever that we shouldn't own old crop corn, and if we do, it's in calls. Those calls would probably be in the July, and I don't know if it's worth rolling those out. I'm not saying you couldn't if you want to hang on to some old crop stuff, but calls at this point I would probably be using against my new crop. Old crop is virtually over. You're still getting a very strong bid, 50s over into Decatur and St. Louis, I believe. So you're back above 650 corn. Could it go higher? It sure can, but it sure feels like to me there's a lot more old crop corn out here than we might think. Maybe I'm wrong, but different areas of the state, I do think there's still more corn out there to sell. And if we're not, it all depends on what the farmer's attitude is. If we're not seeing rain, does he clean out the bin anyway, or does he hang on to it? Those are things that we got to look at. But for the 23 crop, new crop, we've hedged corn already, right? We've got some stuff sold. Elevators have not bought near what they would have a year ago at this time. I'm pretty sure they would tell you that. Main reason for that, I feel, psychology-wise, you're looking at always trying to make the next sale better than the other previous sale. We haven't had that chance. We've saw higher prices last spring, some in the summer, last fall. Really haven't seen anything good since then comparing it to those sales. So you probably have some limited coverage from that standpoint. But we've hedged or sold. What I would be looking at today is buying calls and making some sales. That's really where I'm at. We do have puts in place, but probably not near enough. Some of you do, some probably don't. I don't know that I like buying puts here. I don't think they give us a floor that I'm all that thrilled about, but it is an alternative if you just cannot get yourself to sell anything. But if we're selling corn at 544 the board and we're buying a call, it could be a straight call, it could be a call spread. I've done spreads at 20-cent cost. Maybe I can add 50 cents to this thing. If I hedge it at 544 and add 50 cents to it, I'm almost $6 corn. That doesn't feel too bad, even if corn goes to 7, in my opinion. But, obviously if we're going to run to $7, $8 corn because it's never going to rain again, then, we don't want to limit that. I'm just not one that's going to bet that it never rains again at the moment. If we rally enough, I do think you can get some puts bought underneath the market. That is better than your crop insurance guarantee. And I tried to put that in here at 85% crop insurance, a $591 spring price. You just grow your APH. You've got an embedded put at 502. However, if you grow 5% more than your APH, it's going to go to 477. The only thing guaranteed with crop insurance is dollars per acre, not a floor. That is one thing I have to stress. You have dollars per acre guaranteed. You do not have a floor guaranteed with insurance, because it all depends on what you grow versus your APH. So just keep that in mind. And if you have 80% crop insurance, obviously these floors are lower yet. You would have known that going in when you bought the crop insurance. But right now, I have had people sell corn and buy calls. I just don't think there's a ton of coverage out here to where there's a lot of guys anywhere close to 50% sold. And if you normally figure 220 bushel corn and you're not willing to sell 110 bushel an acre, you obviously feel pretty bad about the crop situation. We have to look at demand here too. Our demand has been fairly poor, and there's been some things obviously that have changed on the production side, but the demand side of the equation is a big deal. If we look here today, again, this being done at noon or a little after, I don't know where we're going to close, but we've saw some midday forecasts that were calling for some heat to return, not just for us, but for mainly probably to the south and to the west. Limited rain, or at least taking some rain out probably, but there's still decent chances for rain for a lot of people. Is it a pattern shift or not? That's the biggest question, right? Because we have crop conditions that really fell off the cliff yesterday in that report. 5% from a national perspective, the biggest 1 week drop since August of 2020, which without going back and looking, I've got to guess that was probably the week after that derecho went through Iowa and northern Illinois in 2020. The biggest weekly drop we've seen for this time of year since 2012. So it's a big drop, and the biggest things that I'm looking at are Illinois, Indiana, Ohio, and Michigan. I think the smallest drop in all four of those states was 10%. Illinois dropped 19. I don't think I've ever seen Illinois drop that much in a week. It may just mean that we were overinflated from the previous week, but needless to say, we've got some low crop conditions for this time of year. We do have a supply and demand report coming out on Friday. It's not unprecedented for the USDA to lower or raise the corn yield in the June report versus May. It doesn't always happen, and it typically doesn't. But typically, if we have dry weather like this or rough weather in May, they have been known to do that. And we were obviously plenty dry in a lot of areas in May. And we have some of the lowest crop conditions for this time of year, which would probably make it pliable here for and plausible for the USDA to lower the yield a little bit. But we'll see if they do that or not. For soybeans, obviously we've hedged. We've got some sales made at much higher levels than we are today. We had puts on a good portion of the crop. I think most people do or did, at least that I worked with, but probably not everything is done, right? If you got nothing done, I'm not sure what to really tell you, because we're selling 1150 beans, 1160 beans today. That doesn't sound all that great. Against your costs, if you're profitable, maybe we should be. I'm not going to say that you shouldn't, but it just doesn't sound near as attractive as what we've been used to, right? Puts, you're not going to like what the floor is for those. So we're looking at, okay, what is our guaranteed revenue? One, we should be looking at what's our guaranteed revenue for beans versus our cost structure. But if we just look at trying to find that floor that we have with crop insurance, if you only grow your APH and you took out 85% crop insurance, you do have an embedded floor at 1170, which is very close to where the market's at right now. Took 80%, and only grow your APH, you got a floor at $11, so the market can still drop further. If you would happen to grow 5% more than your APH, obviously those floors are going to drop even more yet. So we have to look at what's our costs and all that kind of stuff, right? I do look at crop conditions in Illinois being the largest soybean producing state in the United States, and we're only 50% good to excellent, that doesn't make me feel all that great for a big yield. But it's only June 6th. We've got plenty of time. I've seen beans look ugly in August, and they still yield well. The one thing I did notice, and I'm not sure if I'm reading too much into this, but 89% of Illinois' beans had emerged in the report yesterday, meaning, or what it should mean, is that we have 11% of our beans that haven't emerged. If that's the case, they're sitting in dry dirt. And are they going to emerge? Probably not, unless we have rain. So that's a little concerning. Double crop bean acres could be something that we have to watch here too going forward if we stay dry. But if we catch the right rains, we can still be in good shape. But those are just some things that caught my eye. From a demand standpoint, we have to watch our demand here. It sure feels like old crop demand isn't going to meet the goal. Our old crop carryout probably is going to increase going forward, and we could have potential, at least our research department is using a carryout figure for new crop beans over 400 million. The USDA is a shade over 300. So that's telling you some things there as far as what our demand looks like. I will say, though, too, that if you just take 1 bushel an acre off the national crop, and things can change dramatically. So we got to keep all that in mind. The crop isn't made. There can be a lot of volatility here with these beans yet. I'm kind of in no man's land as to what I would recommend doing for beans right now, because it sure doesn't feel like I'm not in a hurry to sell them, and I'm not in a hurry to go out and find a floor that isn't any better than my crop insurance either. So if I do sell them, I do want to look at some calls. That's the one thing that we could do, though. I don't think you can lose sight of 24. Obviously, if it's not raining, you may be hesitant to sell 23, so you're probably not going to check out 24. But I've had people already hedge 24 or do HGAs for 24 corn and just get some calls bought. It makes sense, I believe, above $5. If you look today, obviously if we rally corn significantly, maybe inputs change, but dry fertilizer's down. Nitrogen's about half of what it was for this last year's crop. So your inputs are lower, your costs are going to be lower, and we have no guaranteed floor at the moment because we don't have crop insurance yet for 24. We were currently at 5.11 the last I knew for these 24, and we've seen obviously higher than that, but recently we have only seen about 5.18. We hedged some stuff above 5, and this crop isn't as hurt as much as we think. We're probably going to feel pretty good about having that done. So it's something that you've got to be looking at. Whether you don't, even if you're not going to do it right away, it should be on your radar, because if the forecast changes and 23 drops, 24 is probably going with it, and we may not see 5 again. I'm not going to say that we couldn't, but I definitely think it's something that you should be looking at from that standpoint. So if you have any questions or comments